At Red Lion Financial, we have over 2 decades of experience serving the needs of our clients when it comes to retirement, long-term care, and also life insurance. We've been very successful in helping our consumers over the years because we believe in taking an unbiased approach that focuses on education rather than just product pitching. And today, we want to educate you on the differences between tax today money and tax tomorrow money when it comes to your retirement planning. So here we want to talk about 2 different types of money. First and foremost, you have taxed tomorrow money. That is traditional IRAs, traditional 401ks, money that has not yet been taxed. And you also have taxed today money, such as Roth IRAs, Roth 401ks, as well as cash value life insurance. You see, whether it's the left-hand side here, the taxed tomorrow money, or the right-hand side, the goal is the same: to put in this amount of money and get back that amount of money at a point in the future. Again, with tax today money, it's the same: to put in that amount of money and get back that amount of money in the future. The goal to accumulating wealth is to put in less than what you get out, right? Well, on the left-hand side here, people love traditional IRAs and 401ks. Why is that? Because that money that goes in on the front end is not taxed up to that point in time. And again, this is why traditionally, no pun intended, consumers have loved traditional IRAs and traditional 401ks. The fact that their taxes are deferred for a later date. To where when you move over to the right-hand side, has that money been taxed yet once it goes into the taxed today account? The answer to that question is yes. But let's go back over to the left-hand side, the tax tomorrow money. So 10 years from now, 15 years from now, 30 years from now, when one decides to take money out of the tax tomorrow account, is that money taxed at that point in time? The answer to that question is yes. What about on the right-hand side? When one takes money out 10, 15, 20 years from now, is that money taxed at that point in time? The answer to that question is no. As I like to say, on the right-hand side, you are paying taxes on the seed, and on the left-hand side, you are paying taxes on the harvest. Had you rather pay taxes on the seed, or had you rather pay taxes on the harvest? Now, that's a very conceptual statement for me to say because it really depends. It depends on what tax rates are today versus in the future, right? For instance, let's say that tax rates today were 35%, and tax rates in the future are also going to be 35% for our example customer here. You see, with the left-hand side, the money that goes in, that has not yet been taxed. So that 35% tax today, it doesn't matter. But in 10, 15, 20 years from now, when we want to take money out of that tax later account, that money is taxed at that point in time. And based off of a 5% per year growth assumption over a 20-year period of time, that means that our $10,000 is going to grow to $26,532. But is that what our hypothetical retirement saver actually gets after taxes? No, based off of a 35% tax rate tomorrow, what he or she gets is $17,246. Now, let's go over to the other side. Over on the other side, on the tax today account, what you have is that tax rate of 35% is reducing our $10,000 down to $6,500 that would effectively go into our taxed today account, right? But then that $6,500 growing over the next 20-year period of time by 5%, hypothetically, what does that grow to? It grows to $17,246. The exact same as what our hypothetical retirement saver would have gotten on the tax tomorrow account, right? In other words, if tax rates are the same today as what they will be in the future, it doesn't really matter whether our hypothetical saver chooses tax tomorrow or tax today. However, keep in mind that with tax tomorrow money like traditional IRAs and traditional 401ks, what you withdraw during retirement counts towards your provisional income for purposes of calculating Social Security taxation. So that's something to be aware of on that side. Now, what about for the masses and masses of folks that believe that tax rates at retirement are going to be much higher than what tax rates are today? Let's say, for instance, that our tax rate tomorrow changes to 40% instead of our 35% assumption we used previously. Then that means that the new math with a 40% tax on the harvest in the taxed tomorrow account, where the tax is applied at retirement, that means that our customer only has $15,919 after taxes, which is clearly less than what our tax today account would be able to generate at retirement time. So, the main determinant for whether you choose tax tomorrow, such as traditional IRAs or traditional 401ks, or the tax today, such as Roth IRAs or cash value life insurance, is do you believe that tax rates at retirement are going to be higher than what they are today? Because if you believe tax rates are going to be higher at retirement than they are today, then maybe you should consider the taxed today account. And also, again, consider the fact that the taxed today accounts like the Roth IRAs as well as cash value life insurance do not count towards your provisional income for purposes of the IRS taxing your Social Security income. We hope you enjoyed today's video on tax today money versus tax tomorrow money. If you'd like to get in touch with Red Lion Financial, feel free to give us a call at 760-415-6408 or visit our website at www.redlionfinancial.com.